41%, 35%, 50%, three numbers, one index. And they challenge the traditional idea of diversification. 41% of the entire S&P 500 is now concentrated in just 10 stocks. 35 cents of every dollar invested into the index flows toward only 7 companies. And nearly 50% of the index is now connected to companies heavily tied to the AI trade. This isn't a prediction. This is the structure of the market right now, and it represents one of the highest concentration levels in modern S&P 500 history. The index may contain 500 companies, but the weighting tells a much narrower story. Let's go on this. The 10 largest U.S. stocks now account for roughly 41% of the S&P 500's total market capitalization, a historic concentration level. For comparison, during the peak of the dot-com bubble around the year 2000, the top 10 stocks represented roughly 27% of the index. That earlier period became one of the most famous speculative cycles in modern financial history. Today's concentration is significantly higher. Now, concentration alone does not guarantee a market crash. Today's mega-cap companies are also far more profitable and established than many dot-com-era firms were. But historically, extreme concentration has often increased market sensitivity to a smaller group of companies. That is what makes this data important. Now tighten the lens even further. The Magnificent Seven, Apple, Nvidia, Microsoft, Amazon, Meta, Alphabet, and Tesla now represent an unusually large share of the index. As passive investment flows enter S&P 500 index funds, a substantial portion of that capital automatically concentrates into this small cluster of mega-cap companies. And when analysts group together semiconductor, cloud, infrastructure, and platform companies benefiting from the AI boom, nearly half of the index can be viewed as tied, directly or indirectly, to the broader artificial intelligence theme. That means many investors who believe they own a broadly diversified index may actually have far heavier exposure to one dominant market theme than they realize. Here's what the evidence suggests. The S&P 500 has gradually become more concentrated around a small number of mega-cap technology companies. That concentration could continue rewarding investors if AI-driven growth remains strong. But it also means market performance is becoming increasingly dependent on a narrower leadership group. History shows that periods of extreme concentration can reshape both risk and volatility across the entire market. The dot-com era offered one example of how concentration data can signal changing market dynamics long before major headlines appear. And today, many of those same concentration signals are visible again in the data. The numbers are already on the table. The real question is, how many investors are actually paying attention?